This is the ticker symbol for one of the most popular ETFs, and this is the one for one of the most popular index funds. Both of them follow the exact same index, so what is the difference between them? They follow the S&P 500 index, which is considered by many one of the best indexes for long-term investments. To follow this index, you've got two main options: an index fund or an ETF. They're similar in a lot of ways, but there are small yet important differences between them. Determining which one is right for you depends on many factors and your own personal preferences. This video will go over their similarities and key differences, so you can make a more informed choice between them. Both index funds and many ETFs aim to follow an existing index. Some of the most famous indexes are the S&P 500, Nasdaq 100, and the Dow Jones Industrial Average. The primary reason for following an index is that index funds and ETFs can often beat actively managed funds in the long run, especially if you factor in the lower expenses of ETFs and index funds. They can have yearly costs that are more than 1% lower than actively managed funds, which is a big advantage over long periods of time. Index funds are funds that represent a part of the market, an index. It can be made up of a collection of stocks, bonds, or other securities. In the case of an index fund that follows the S&P 500, it is a collection of the 500 largest publicly traded companies in the US. You probably know a large number of the companies in this collection. Index funds also have fund managers, whose job it is to make sure that the fund tracks its underlying index. Because the index provider creates and maintains the index itself, the job of the fund manager is only to follow the index provider. The index provider in the case of the S&P 500 is a committee of people that selects each of the index's 500 companies based on a number of predetermined factors. ETF stands for Exchange Traded Fund. They also hold a basket of assets to follow an underlying index, just like index funds. But ETFs work more like equities than normal funds. They are listed on market exchanges like the New York Stock Exchange and the Nasdaq, just like individual stocks. They can be bought and sold just as easily as normal stocks, with fluctuating prices throughout the day. There are some clear differences between index funds and ETFs. ETFs are far more liquid than index funds. You can buy and sell an ETF whenever the stock exchange is open, as opposed to index funds that are only priced at the end of the day and can take longer to buy and sell. What you buy or sell an index fund for isn't really a price, it's the net asset value, or NAV, of the securities in the fund, and you will trade at the fund's NAV at the end of the trading day. In contrast, ETFs can be traded throughout the trading day, just like stocks. This also gives ETFs the ability to make stock orders. The cost between ETFs and index funds that follow the same index can also differ. ETFs typically have expense ratios lower than most index funds. This can provide a small edge to ETFs, but ETFs can have higher trading costs than index funds. Expense ratios is a cost that is taken as a percentage of your total investment, often on a yearly basis, while trading costs only occur when you're buying or selling the asset. The ability to trade an ETF following an index like a stock can also create more of a temptation to trade that would not have been there with an index fund, which can encourage potentially damaging investing behavior, such as poor market timing and frequent trading that could increase expenses. It is also good to remember that choosing which one you should invest in does not have to be an either-or question. If you are comparing an ETF and an index fund that both track the same index, The one with the lowest cost is generally the smart decision. Both ways of following an index can be good choices for long-term investing.